So what is basically working capital? Working capital management helps company in effective use of current or short-term assets and maintaining sufficient cash flows. It includes day-to-day business, the management of receivables, inventories or stocks, and payables. So net working capital is the difference between current assets less current liabilities, or short-term assets less short-term liabilities, up to 1 year. Balance sheet items. So while working capital is about to determine an amount, the cash conversion cycle is rather about to calculate the number of days that it takes to a company to get the total cash from its clients' receivables, from selling its inventories or stocks, and after paying its suppliers. I love this slide because it really brings the data to life. So how does it work, cash conversion cycle? You have here days inventory outstanding. So we speak about the average number of the days that the company holds inventory before turning it to the sales. So the formula days inventory outstanding is equal to the average inventories divided by the cost of goods sold, right, from the P&L, multiplied by days in accounting period, 365 days. It is equal to 60 days. So in simple words, what does it mean? It takes 60 days to sell your inventories. Then you add the days sales outstanding. What is it? We speak about the average number of days that it takes a company to collect the payments from the customers from a sale. So the formula days sales outstanding is equal to average receivables divided by the sales multiplied by 365 days, which is equal to 35 days. It means that it takes you 35 days to get the cash from your customer in average. Less days payable outstanding. So this is the average time that a company takes to pay the bills and invoices to the trade creditors. The formula days payable outstanding is equal to the average payables divided by the cost of goods sold multiplied by 365 days. It's equal to 25 days. So in simple words, it means that it takes you 25 days to pay in average your suppliers. What is then the cash conversion cycle? It is equal to the days inventory outstanding plus days sales outstanding less days payable outstanding. So in this case, this is 70 days. What does it mean? This is a metric that represents the length of time, so it's 70 days that it takes you as a company to convert your investments in inventory and other resources into cash from sales. Is it good or bad? You have to compare it mainly with the competitors and the market requirements or only legislation. So what are the key questions in working capital management here? So working capital management raises some questions. Key questions in working capital management include the optimal level of cash. There are liquidity ratios which can help, such as current ratio, quick ratio, cash ratio, and many others. So we speak about what is the optimal level of cash, what is the use of liquidity ratios. Then speaking about net working capital, once you get the net working capital, how to finance the cash gap. So it means that the idea here is that your short-term liabilities are to be higher than short-term assets here. Speaking about the cash conversion cycle here. Key questions is also how to reduce the cash conversion cycle. So how to increase payables, okay? How to decrease receivables, how to decrease inventory. All that is important to finance cash gap. So maybe you need some short-term loan. Will you take it or not to finance your gap, cash gap? How to get such short-term loan? How to get short-term working capital? All those questions are important to consider when speaking about working capital management.